Good day, everyone. Welcome to our webinar for April 2020. It's been a hectic month, and I'm sure if you're listening to this, you'll probably be in lockdown. I'll begin this morning, as we usually do, with America. Let's have a look at what's going on there. America is in partial lockdown. Its GDP has been estimated to shrink by anything between 10% and 14% in this quarter by various economists. Unemployment is expected to rise from 3.5%, which was a record low, of course, to as much as 10%. The weekly jobless claims, are expected to surge from 280,000 to about 2 million. And this is tolerable so long as it is only this quarter. If you compare this to other major events which are not really comparable but perhaps similar, like the Great Depression. In the Great Depression, unemployment reached 33%. During the 1918 Spanish flu, 50 million people worldwide died, and America's GDP fell by 7%. First world countries are trying to obviously avert this economic disaster. And to do that, they first of all dropped their interest rates to zero or close to zero. The US has announced a $2.2 trillion package of aid that it will give to various companies and individuals. Europe is increasing its quantitative easing program. And basically, everybody is trying, all central banks around the world are trying as hard as they can to compensate to some extent for lockdowns and for the impact of the coronavirus. And this is a unique event in financial markets. We've never had a bear trend which has been created by a pandemic before. So it's very difficult to predict what will happen. If you look here at the chart, you'll see that we had quite a sharp fall. This is obviously the S&P 500. I've put on a 65-day exponentially smooth moving average, and you can see that the impact of the virus has been to take the market down quite sharply. The initial sell-off was about 34%. But since then, we've had approximately a 15% recovery in about 6 or 7 days. So you need to be watching the market, the daily market action very, very closely at the moment, because this could be a dead cat bounce. It's not strong enough yet to be called anything else, really. Most bear trends have a sharp rally somewhere in the middle of them, which usually takes them up as high as half of what they've fallen, which is pretty much what this rally has done. And we can see that it's starting to hit a little bit of a ceiling here at around 2630, somewhere around 2630 on the S&P 500. Of course, we use the S&P 500 because it is the world leader in stock markets. What happens on Wall Street generally happens in the rest of the world as well. We said that this would be a V-bottom right at the beginning in January when we first talked about the corona downward trend. And I believe we also said then that it will track the progress of the virus itself, the perceptions of how quickly the world is going to get on top of this pandemic. Of course, the danger in the situation is America. America is by far the largest economy in the world, and what happens there, as I said, generally is reflected in other economies around the world. So, from what I can see and read, it seems like the lockdown in America is very patchy. It's only being implemented in about 22 states, and there is no national lockdown there yet. But the number of cases in America is rising rapidly, as are the number of deaths. They've got over 3,500 deaths, which means they've got more deaths now than Italy had. Sorry, not Italy, China had. and they're on their way to being the worst affected country in the world. Of course, the Northern Hemisphere is moving slowly into summer, just as we are moving slowly into winter. We know from scientific experiments that the virus is happiest at about 3 degrees centigrade, which is pretty cold for South Africa. There are not many places that get down to 3 degrees centigrade, especially during the day. In Europe, of course, that's commonplace, as it is in America and in China, especially during the winter months. Now, that switch from winter to summer may help the Northern Hemisphere, and it may be a problem for us. So now, our general perception is that there's nothing that happens in the markets that cannot be capitalized on. Every problem is in effect an opportunity. Whatever happens, there's a way to make money from it. You just have to be perceptive and aware enough to spot those opportunities. On the 31st of January this year, in an article, we suggested that Prosus was a good share to look at. It was then trading at 30% below its net asset value. Of course, Prosus, its big asset is 31% of Tencent, which is a Chinese gaming and social media giant. That company, Tencent, has seen a 25% jump in its number of subscribers since the lockdown in China. Whether this will be sustained or not remains to be seen. But certainly, the news for Prosus is not bad. And if we look at the chart quickly, you'll see what I'm saying. There you can see that Prosus is actually at the highest level it's been this year. And yes, it was initially impacted by the coronavirus, the pandemic, but it has recovered very dramatically and is sitting at the highest level it's been at this year. Okay, let's turn our attention now to the South African economy and what is happening here. Of course, Cyril Ramaphosa has used the powers that he is given under the Disaster Management Act to impose a 21-day lockdown. We are in day 7 of that lockdown. Sorry, day 6. And of course, the cost of doing something like this to the country is enormous. But it is cheaper than allowing the epidemic to run riot through this country. Of course, it will be wasted, the effort and the cost will be wasted if people do not comply with the restrictions which the government has imposed. So we need to consider the impact on the world and the South African economy. It's now estimated by some economists that this year GDP growth in this country will be minus 3.5%, somewhere in that vicinity. And that, of course, will lead to a sharp drop in tax revenue, and that may in turn lead to stronger measures by the government to cut government spending, and particularly the wage bill, the government wage bill. Thousands of small and medium-sized businesses have been closed. Many of them will not recover. But on the bright side, the petrol price has come down by R1.76 per litre today, and that will put quite a lot of money into every South African's pocket if it's sustained. Eskom, of course, has ceased with power shutoffs, with load shedding, and is now in a position to shut down various coal-fired power stations and engage in planned maintenance. So that is quite an important thing. It means that when we come out of lockdown, or when the economy recovers and power consumption starts to build up again, then we should have less load shedding. So basically, power consumption in this country has halved during the lockdown period, from about 31,000 gigawatts to around 16. Of course, Cyril Ramaphosa has said that he is also willing to look at either closing or selling some of those old coal-fired power stations. So that is a shift in policy as well. Basically, it means that it has been accepted at government level that Eskom cannot have a monopoly over the production of electricity in this country. That's a step forward. Of course, Tito Mbowene's budget cut of 160 billion rand off the civil service wage bill over the next 3 years still really hasn't been tested. Of course, at the end of this period today, in fact, the civil servants will receive their salaries, and then they will know whether or not they've received the 1.5% which the government has said they will get, or whether they've got the originally agreed CPI plus 1%. I suspect they've got the 1.5%, and of course the unions are in a difficult position right now. They can't really have a march or a strike because they're not allowed to congregate, and they're not allowed to move around. So whatever strike action they're planning, it will have to come after the 17th of April. So in effect, the lockdown has helped the government to achieve its goals, at least in terms of the civil service wage bill. Of course, South Africa was already in a recession after the December quarter's 1.4% drop in GDP. And now we've had the Moody's downgrade, which in my opinion was widely expected and substantially discounted, but it did have an impact. It's taken the rand down, as I'm sure you've seen. So now we're at a position where we've got about 1,350 COVID cases in South Africa and 5 deaths. The rate of infection appears to be slowing. It looks like the lockdown is working, but it is early days, and we do not know how many people have the coronavirus but have not yet been tested, and that, of course, is the key. I know that there's an extensive testing program going on in Alexander Township at the moment, so maybe that will help us to see what is going on and to identify hotspots in that area. The government has got 10,000 people working on testing and tracking down the people that positively tested individuals have been in contact with. But until we have widespread testing, we really won't know whether or not this virus has taken a grip on the country. Of course, in South Africa, we have the huge disadvantage that we've got 8 million people living with AIDS and millions of others with tuberculosis and other diseases. So our immune system as a country is not very good. And if the coronavirus does spread, it may result in a much higher death rate here than elsewhere. South Africans, of course, are not used to obeying rules. You can see this if you drive on the roads. You can see it by watching the taxis in this country on the roads. We are not used to obeying rules. So I'm not sure whether the lockdown will have the desired effect, but so far it seems to be working reasonably well. The rapid declaration of the lockdown helps. Bill Gates has said that if you can achieve a lockdown in your country before the first death, then you've got a very good chance of controlling the virus. So that is what we actually did here, but only by 1 day, I must tell you. Central bankers, of course, are implementing measures all over the world to counter the economic recession, which is almost certain to result from this virus. South Africa has very few reserves, basically no reserves to meet this situation with. But we could approach the IMF, the World Bank, or the BRICS Bank, which we are a member of, and get a loan from them. So that's one possibility. There's another possibility, which is that the government could decide to lower the reserve rate, and I believe that they are going to do that. The reserve rate is the percentage of funds that a commercial bank, has to hold out of whatever is deposited with it. So normally, if you go to the bank and you deposit 1,000 rand into your account, the bank does not keep that 1,000 rand. It keeps only 100 rand of it, roughly, and then lends the balance out to someone else in the form of an overdraft or whatever. So that would be a 10% reserve rate, where they're keeping 1/10 of what you deposit with them. If that reserve rate is reduced by 1%, you can imagine it will release a huge amount of loan capability in the hands of the commercial banks. It's estimated that by lowering the reserve rate, they could release 320 billion rand for the banks to give in loans to people over this tough period. Of course, The other thing is quantitative easing. The South African government has never done this before, but I believe that they are involved in it now because they've talked about printing money, or not printing, but creating money to buy back government bonds. And that is in my book, Quantitative Easing. This is, of course, not a new idea. It started in Rome 2,000 years ago, when the Romans used to call in all the gold coins in the realm on the pretext of reminting them with the new Caesar's image. And they brought in all the gold coins. Of course, they kept careful notes of who gave them what number of coins. And then they melted them all down, added 20% of lead, reminted them with the new Caesar's face, and handed everybody their coins back. And when they'd finished, they had 20% left in the bottom of the pot, which they used to fight the next Punic War. So in those days, they called it debasement. Today, we call it inflation. But it is essentially the same thing. It is a subtle and undeclared form of taxation. The problem with it, of course, is that there is a significant moral hazard involved here. In other words, once you start doing that, it's very difficult to stop. It's like heroin, you know. If the government gets used to printing money to pay for things, then it can print money to pay for anything. And then we can be in that situation that Zimbabwe was in, where they basically printed their currency out of existence. So we don't want that. But I believe that in the current situation, with a very low inflation rate, which South Africa does enjoy, we are in a position to do some quantitative easing, and that will help us to counter the impact of the coronavirus on the economy. Of course, the Reserve Bank did drop interest rates by 1%, and that is a big help because for the average bondholder, it will cut their costs by about 1,000 Rand a month. If you add that to probably another 1,500 Rand that they might save on petrol due to the drop in the petrol price, then you can see that there are a number of good news signs. There are some green shoots out there that could help us. There are, of course, going to be some casualties of this lockdown. The first one that we've read about in the paper is Edcon, although the unions are apparently trying to get some new scheme going to keep it alive. But I seriously have believed that Edcon was going to fail for some time now. I believe the last rescue package, mainly provided by its landlords, was a waste of time. Edcon has not moved with the times. Its technology, its method of selling it has lost the imagination of the South African public. And I think that in the end, the only solution will be for it to go into liquidation. The other casualty is likely to be SAA, and that, of course, depends on the government's reaction. But they've had to stop all their flights now. So I don't know what SAA is getting in terms of income, but I suspect it's very little. And if we look around the situation, the month of March was probably not too bad, but the months of April, May, and June this year are likely to be the tough months. That's when small businesses are going to go out of business. And we should see that in the figures. Hopefully the government's efforts to compensate will be at least partially successful. Now, of course, all these things are reflected in the Rand. So we need to just have a quick look at the Rand and see what's going on there. Right, I'm going to put a bit more detail on the screen here. That's a 2-year chart. And as you can see, I've marked it here that there's a support line at around 15 Rand 50, which began some time ago in September 2018. That support has been broken over here, and in the last confidential report on the 4th of March, earlier on, we drew your attention to the fact that the Rand had broken quite convincingly through this support line, and that meant that it would probably weaken. And so it has. At the time, we didn't really understand why it was breaking through that line. We certainly didn't think it was because of the coronavirus, but as you can see here, there's been an international shift towards risk off. So international investors have shifted from risk on to risk off. That means that they are withdrawing funds from emerging markets like South Africa and placing them in United States Treasury bills, usually the 10-year Treasury bill there, which is perceived as being the most secure investment in the world, probably, for some reason, which I don't fully understand, but it is. And so because they withdrew their funds from South Africa, the rand has fallen now to as low as 18 rand to the US dollar. It's about a 16% fall in a single month. So what this shows you is that even if you don't know the reason for a technical support line to be broken, you need to pay attention. You will find out the reason later, but you need to pay attention for your investments as soon as you see that break taking place. And that is because there are people in that market who know far more than you do about what is going on. They are acting on that knowledge, and that is pushing the indicator that you're looking at through that support level. You get that early warning. Later on, you can find out why and rationalize and argue and so on. But at the time that it happens, you need to act. Anyway, international investors, as I said, are running for safety, rushing for safety into the US T-bill. The yield on that 10-year US T-bill has dropped now to 0.72%. In other words, it's less than 1% per annum, which, given the 2.2% inflation rate in America, means that investors there are willing to take a 1.5% negative return just to be safe, which is quite interesting. If you compare the South African rand to other currencies, the Brazilian real in that same month has fallen 15.4%. So we're down about 16%. The Brazilian real is down 15.4%. The Mexican peso is down 27.5%. Even the Australian dollar has fallen about 6.6%. So the rand is not doing too badly amongst the emerging market currencies. And we believe that the rand will recover as the markets normalize. Our 10-year bonds at the moment are offering more than 6% in real interest rates, a positive 6%, and you can compare that with the negative 1.5% that investors who put their money into the T-bill are having to take. They're actually losing money on that investment. So obviously, I think that as soon as things start to improve a little bit on world markets, you're going to see a rush of money out of the T-bill and into emerging markets, and particularly into the South African long bond, the 10-year bond, which I think is now very underpriced. All right, let's consider now the oil market. Just going to switch to the Brent chart. And once again, I want to look at a 2-year graph here. Right here you can see the 2-year chart of North Sea Brent oil per barrel. On the 4th of March this year, in our confidential report, we drew attention to the fact that the oil price, the price of North Sea Brent oil, had fallen down through key resistance at this level of $50.80. At the time, we were not sure why it had broken down through that support level, but and we speculated on a few things, but the real reason was that international commodity speculators already knew that the coronavirus was likely to turn into a worldwide pandemic, and they were guessing that that would result in a major sell-off in oil, a reduction in demand for oil. So they were selling stocks of oil at that time, which caused the chart to fall. Now, it's very difficult for a private investor to know this kind of information, but you can see it in the chart. So you need to pay attention to breaks like this, where a market breaks down through a key support level. Of course, the fall in the oil price has got a lot of benefits for people all over the world because every person uses oil, at least for transport, if not for both transport and products. Anything which has got plastic in it has got oil in it. So a significant drop in the oil price like this one will reduce world inflation dramatically. It will also put more money into everyone's pocket. So it has it stimulates the economy as well. And if you combine that with the massive stimulation of central banks around the world, then you have a situation where you can talk about a recovery in the economy, in the world economy. Smart investors are already picking what they perceive to be the low-hanging fruit. So you need to think about that and decide when exactly you want to get back in. As we've said before, we believe that this downward trend is going to be a V-bottom. It's going to turn very sharply and go straight up very, very dramatically, probably sometime between now and the end of the year, if it has not already started. But remember what I said, the current upward trend may be a dead cat bounce, so be a little bit cautious of that. Let's just talk about a few other commodities. Platinum at $730 an ounce is being boosted by three factors, three new events or developments. The first is a new auto catalyst, which will contain more platinum and less rhodium and palladium. That will obviously increase the demand for platinum. There's also a platinum coin being minted, which may increase demand for platinum. And finally, of course, Amplats has had to shut down 2 of its converters, and that has resulted in a sharp reduction of platinum production from them. Of course, the Chinese economy, which is the main purchaser of commodities from South Africa, is expecting its economy to contract quite sharply. Nobody quite knows by how much, but at least probably 2%. That will impact on their demand for commodities. China takes about 18% of South Africa's annual exports, and 85% of that 18% is commodities, production from the mining sector. But China appears to be on top of the coronavirus. The efforts are being made there to get the economy working again, to get everyone back to work and get the economy producing. Chinese production, of course, may drop as the pandemic goes worldwide and the demand for their products declines from other countries. Closing down the South African mines during the lockdown will be a problem. All mines have been closed, almost all mines have been closed during the lockdown. And some marginal mines, those which do not have a strong balance sheet and which are marginal in terms of the price that they get, will probably go bust. Harmony, for example, is putting all its mines on care and maintenance. Many mines have also declared a force majeure, which means that they cannot comply with their contractual obligations because of the lockdown. The fall in the rand, on the other hand, has helped the mining industry significantly because they obviously will be getting more rands for their dollars, pounds, or euros. All right, now let's turn our attention to companies. Obviously, very many high-quality shares have fallen and could be bargains at the current prices. Perhaps the best example was Capitec. I'll just put that on the screen and you can see what's happened there. As you can see, Capitec fell from levels around 14 Rand a share down to as little as 5.30 Rand over here, and then recovered quite sharply, but it seems to have found some sort of middle ground here around 8 Rand. So that is an example of the kind of share that will perform very well as soon as the economy gets back to something like normality. A sharp downtrend in markets, if we go back to, let's look at the JSE overall index, you'll see what I'm talking about. A sharp decline in markets is usually followed by a sideways trend before it moves up. In other words, investors have to get used to the new situation, during which time there's some backing and filling. Then it moves up. You should at least wait until the downward move is finished before you think about getting in. Do not be too impatient. But if you buy in now, you are certainly doing much better than those who bought a month ago, and you can comfort yourself with that, provided, of course, you have a strict stop-loss strategy in place. Almost all listed companies have issued some kind of statement about how COVID-19 is impacting on their business, and I urge you to read those. All right, let's look at some individual stocks now. 91 is a company which has been spun out of Investec and listed separately on the stock market. It listed right into the teeth of this lockdown on the 16th of March. Here you can see what's happened to the share over the last 2 weeks. Initially it fell, of course. It opened about 40% below the pre-listing price of the share. This is an asset management business, as I said, spun out of Investec, and it has 121 billion rand, billion pounds sterling under management. So it is a massive asset management company. It's also a very good rand hedge. So we see this as an international asset manager, and we see it as being quite cheap at current levels. So there's a potential opportunity, something for you to think about. It's already obviously dropped a lot of value on the market. The next share I want to look at is a share called VEVO. This is an interesting little company. It owns petrol stations, most notably Shell petrol stations. And here you can see it's a fairly thinly traded share. It's got about 2,000 Shell petrol stations. Most of them are in South Africa. And it's recently bought another 230 petrol stations from Engen in 8 countries which it didn't have a presence in previously. In its results to the year ending on the 31st of December 2019, it showed its turnover up 10% and headline earnings per share were roughly flat. But it's on a multiple of 9.5 and a dividend yield of 3%. It is fairly thinly traded, which means there is some risk. But JP Morgan says that it is materially undervalued, and that's probably why you can see this very strong upward move in the share price yesterday. Okay, let's just talk about Sasol. Sasol is not a place where anybody is looking right now, but it used to be a high-quality blue-chip share. The share has fallen all the way down to about 37 Rand, 36, 37 Rand, bearing in mind that it has a net asset value of 353 Rand. Obviously, the thing to know about Sasol is that 50% of its income comes from oil. So it's been hammered by the drop in the oil price and somewhat compensated by the fall in the Rand. I think it may be cheap at these levels. 18 months ago, this share was selling for 578 Rand a share. Now you can buy it for 36 Rand. Still feels a bit risky, but if you put in your stop loss, you may well have found yourself a bargain. Wouldn't surprise me to see this share go up very strongly as the markets internationally recover. Then we've spoken about Prosus, and the other share that's in that same category is Naspers. Naspers is trading at about 50% below the value of the assets which it owns, listed assets. One of the reasons for that is its complicated N share structure, which you should go and read about. But it does have a substantial interest through Prosus in Tencent. It owns 73% of Prosus. I think it's still very undervalued. I've always thought that this share is worth about 5,000 Rand a share, and as you can see, it's trading at the moment for about half that. Then let's talk about MTN, the MTN group. This share has also been hammered down by COVID-19. As you can see here, it was trading up here at about 88 Rand. And after yesterday, you can get them for 48 Rand. So it's offloaded almost half its value. Obviously, this is because it has an exposure to Nigeria, which is an oil-producing country, so that fall in the oil price will have an impact. And also, nobody really knows what COVID-19 is going to do to Africa as a whole. And all of MTN's business is in Africa, so there's another aspect there. But I think the share is probably cheap at the current level. One thing you must understand about MTN, at the end of the year, at the end of their last financial year, they had a cash pile of 8.3 billion Rand at year end. And they added to that another 8.9 billion rand from the sale of ATC. They also have 23 billion rand in overdraft facilities and loan facilities. So effectively, they've got a 40 billion rand of headroom, which puts them in a very strong position, not only to get through the COVID-19 event, but also to continue growing in the future. We believe that the share is worth about 100 rand a share. And as you can see, it's trading for 48. And it's probably at least 25% below its true value, even in this market. Finally, I want to draw your attention to a little company called Alaris. Don't often talk about this company, but it's an interesting little business. It designs and manufactures RF antennas and communications equipment, frequency spectrum equipment, and electronic warfare, testing and monitoring. In other words, it's a very specialized electronic market in radio aerials and related products. These products are sold all over the world. South Africa only accounts, I think, for about 10% of its sales. It's a very specialized market. But in its results to the 31st of December 2019, it showed turnover up 60% and headline earnings per share up 256%. And clearly, if you look at the chart here, I'll just put a bit more data on the screen, you can see that this share has not been hugely impacted by COVID-19. And in fact, they don't believe it will impact their business very much. The people who buy these products are going to continue buying them because they are mostly governments and large companies. It also trades with reasonable volume, which would allow a small investment. So it's got about 60,000 rands worth of shares changing hands every day. And that means that if you're obeying our rule of 3 times, then you could probably buy 20,000 rands worth of these shares and be comfortable that you could sell out on stop loss if you wanted to. Okay, that's the shares that I wanted to draw to your attention. Now, I just want to point out one thing about this situation that we find ourselves in. If you look at any of the shares, let's take a share like Standard Bank. I mean, this is a blue chip South African share. Nobody can deny that. If you had bought this share some time ago and you had a stop loss strategy, you would be out of it by now. The share has fallen from the levels pre-corona of about 167 rand, and it's now down at 100 rand. So if you had any kind of stop loss level, you would have been out of this share, let's say at 150, and you could now buy it back for less than 100 rand. The point I'm trying to make is that stop loss is very, very important. You need to apply a stop loss strategy in your portfolio. Making money in the share market is not so much about making it as it is about not losing it. That's the thing that you've got to bear in mind. Stop loss strategy is vital. It would have helped you in this situation where nothing else would have. Anything that you look at, if you look at the S&P 500, there was plenty of time to get out on stop loss in this downtrend. As you can see here, it went down quite evenly. There were plenty of opportunities to get out of the market before it touched bottom, down 34%, if, of course, it is at the bottom. All right, folks, it's been a very exciting month. I think there are lots of opportunities in the market for you to look at, and I urge you to be careful, and if you buy anything, implement a stop loss strategy. I'll talk to you again next month.